So let's look at equity investments when they're using the fair value through net income method. Now, when you have an equity investment, there's three things really that's going on. We can either account for it fair value through net income, we can use the equity method, or we can consolidate. If we own less than 20% of the stock, we use the fair value through net income. If you own 20 to 50%, typically you are considered to have significant influence and therefore use the equity method. However, if you qualify for the equity method and you deem or elect to use the fair value option, you are allowed to do so. If we own 50% or more, we are considered to have, or more than 50%, which 50.1%, I guess, or more, we have a controlling interest, therefore we consolidate the financials. Now, according to US GAAP, it says significant influence. It doesn't give us a strict cutoff of 20%. So if you have a company and you only own 10%, but you elect one of the 5 board members, well, that means you have 20% control over the board. Therefore, you may be considered to have significant influence, even though you may only own 10% of the shares. So you do have to stop and think. It's not just a hard, fast rule. But if we lack significant influence, which the rule of thumb is we own less than 20% of the stock, is a good sort of ballpark figure, we use the fair value through net income method. If you own 20 to 50%, typically you use the equity method, and beyond that we consolidate, so more than 50%. In this role, we're only going to look at the first two options. We will not do consolidations until you get to advanced, which would be next semester, I assume, for most everyone. So in this, we're going to look at the fair value through net income option and the equity option. So let's start with fair value through net income. On March 31st, Chow Brothers Incorporated bought 5% of KT Manufacturing's capital stock for $55.1 million. KT's net income for the year ended December 31st, 2024 was $81.7 million. The fair value of the shares held by Chow was $38.4 million on December 31st, 2024. KT did not declare or pay a dividend during 2024. So that's important, because if we did receive that dividend, we'll look at an example where we did here in a few moments. So what is the appropriate journal entry? Well, here we only own 5%, which means this is just a normal investment. We lack any significant influence over the organization, so therefore use the fair value through net income. Basically, what that means is we will record the investment, any dividends we receive we'll record, and then at the end of the accounting period, we have to mark the position to market or record it at fair value. So we have to adjust our carry value of our investment up or down based on what the fair value is at the end of the period. So let's start with March 31st when we purchase this. What are we going to record? Well, when you purchase an investment, you're going to record an investment. So here we're going to record an investment in equity securities. Now again, there's other names for it, but that's the primary. Now we probably will keep separate an investment in equity securities versus an investment in equity affiliate, which you would use if you use the equity method. So it's probably going to be 2 accounts because you want to distinguish between the two, be able to track them. It doesn't have to be, but it could be. So investment in equity security, that's an asset to our company. We're going to record that on our books at 55.1. That's the purchase price. That's how much we spent on it. So 55.1 there, and we're going to credit our cash because we actually purchased the investment at that price. Now, how does this impact us? Well, really, it's just an asset exchange. So here, I'm going to do it this way. It's a plus and minus of 55.1 to our assets. Now, it is an investment here. So when we're using the equity method for investment, this is investing activities. So therefore, we would do an outflow of 55.1, and this would be from investing activities. Now, it could be operating depending. If you had like a securities trading desk, this was your sole operating goal was to invest and make money, then it could be operating, but for the most part, it's going to be investing. All right. Now, December 31st rolls around, and a couple of things to consider here. One, under the fair value, we do not record the income of the other company, so we can ignore that. It's just added information. Sometimes you need that so that you can decipher what you need to pull. We would also record any dividends that were issued and paid during that time period. In this case, we do neither, so we have no additional entry. Okay, so I'm going to make a note here that we would record, and let me just sort of merge these. we would record dividends that we receive. We never adjust for net income. Of the investee. So in other words, we've invested in their stock. We would never record their net income on our books. We would if it was the equity method, but for the fair value through net income, we would not. We would only record dividends if they had declared them. They did not, so we'd have no entry there. All right, now when we get to the year end, also, we have to record fair value adjustments. So under the fair value through net income, any unrealized gains or losses will become part of income during that period of time. So we have to mark the position to market. MTM is what we always called it in the workforce. So mark to market. In other words, we have to adjust to fair value at the end of the accounting period. So the first thing we need to figure out is, well, what is fair value? Well, in that case, we go out and pull the proper information and say, hey, it's trading for this amount. As of December 31st a year, we own this percentage of it. So therefore, this is the value. Great thing about textbook learning is they have to sort of give it to you. But keep in mind, it's not just given to us in the real world. We actually have to go out and find the fair value. What's the price at the close of the market? How many shares do we own? Multiply it out, find the fair value at that point in time. In this case, we did all that, and we found that the fair value of the shares is 38.4 at December 31st. So if we gain value or lost value, well, obviously we paid 55 and it's down to 38.4. We have lost a little bit of value there, a good bit of value. So we have to mark to market. We have to adjust for the fair value being reduced from 55.1 down to 38.4. So to do that, you need to first find the difference. Well, 55.1 minus 38.4 is a difference of 16.7. So we've lost $16.7 million on this transaction so far. Under U.S. GAAP, we do have to mark that to fair value. So what are we going to record? Well, one, we're taking a loss. So we're going to record a loss on investment here. Now keep in mind, this is not a realized loss, but it will be reported in net income. So it's unrealized, but it is part of net income. So you want to make sure that you hit an account that's actually going to show up on your income statement. And we said that was 16.7. Now, in that, what are we going to adjust? Well, we're not going to hit the investment account. We want to carry the investment at its historic cost, the 55.1. So what we're going to do is we're going to hit some type of fair value adjustment. In our class, we're just going to call it fair value adjustment. That is a contra account it goes with, so you can't have a fair value adjustment without the investment account in this case. So you got to net those two. So when you report it on the balance sheet, you're actually going to net them. Now you won't show them as two separate accounts. You'll show the net value of what they currently are. Now, a lot of this came out because carrying investments at historic cost just did not make sense because the price fluctuation was so drastic. So you may buy $100 million in investments, but it could be worth 5 cents, and it's not right to show an asset at $100 million when it's really only worth 5 cents at that point in time. So that's the reason we do this fair value adjustment, to show the reality of your assets at that time so you can get a clear picture. Now, it can change tomorrow and you can recoup all of that, but we need to reflect actually what exists at the time of producing your financials. All right, so how does that impact our financials? Well, one, it's taking our assets down 16.7 because the fair value adjustment here is contra to the investment. It's married to or netted to. Bonded to, however you want to say it. They're compared there. They can't exist. This can't exist without that. So when you have that contra, you have to net the accounts. What else? Well, we're taking a loss. That is going to impact our equity. Now be careful here. Not all unrealized losses hit the income statement. In this case, this unrealized loss will hit our income statement, so it's going to impact us. So our losses are going to go up, causing our income to be reduced. So in this case, it will show on the income statement as part of income, not just part of other comprehensive. Now, there would not be any cash flow impact here because there's no cash. We're not actually paying for this. All right, and the last part of this says, at what amount will Child Brothers report its investment? Well, we have to carry these at their fair value, so we're going to report it at the 38.4, that net value between the 55 and the 16 there. Okay. Now, on January 20th, we sold it for 31.7. Prepare the journal entries to record the sale. Well, at this point in time, remember, we're carrying it at 38.4, I believe it was. Yes, 38.4 right there. So we're going to take an additional loss here. So prior to, there's a couple of different ways you can actually do this. I'm going to show it in 2 entries just so you can see. First and foremost, we're going to go ahead and record the rest of that loss. Apparently we decided that this was just not a good investment. We're going to cut our losses now and go ahead and sell it. Now keep in mind it is saying unrealized, but from our standpoint the unreal and the real get rolled into our financial statement and it all becomes part of one number. So since it shows up on the income, we're not going to show a realized loss and then an unrealized loss on your income statement. That would create a lot of confusion for people who didn't understand. So what we're going to do is we're going to show the total amount of your realized and unrealized losses combined on the income statement, and then we'll footnote the difference or what creates it. So you don't necessarily have to have a separate account here, but I want to make sure you understand that this is not a realized loss and it does go in income. Now it becomes realized when we sell it, so that's okay, but we're going to go ahead and mark the fair value here so that we see that additional loss, and we're going to go ahead and record the fair value adjustment. Now you can actually do this in 1 entry instead of 2, and a lot of companies, so that they will be able to, will reverse the original and then just record the full amount of the loss. So the reversal of this and the recording of the new loss actually creates that income for this year. But anyway, no matter how you do it, I can show you that method as well. Here we're going to record that loss in the fair value adjustment. Once we do that, that again is bringing our assets down a further 6.7. We are recording a loss, so our equity is going to go down. This does show up on the income statement, so our expenses / losses are going up, and when those go up, our income goes down. Now we will hit statement of cash flow, but not just yet. We're going to do it right here when we record the sale. So now when we sell the investment, we're going to get the cash. We sold it for 31.7, so we're going to put that in there as a cash transaction. We're receiving payment for it. We're going to hit the fair value adjustment account. Why? Well, we need to get rid of that fair value. It's sitting there at the 16 plus the 6, which gives us 23.4, so we're going to remove that. You're like, wait a minute, we're not reporting. Yes, we are, because the unrealized hits. So it is a realized loss in that instance, okay? So here we're just simply getting rid of the fair value. We've already recognized all the loss, 16.7 last year and 6.7 this year. And then we're going to go in and we're going to remove the investment because we've actually sold this position. So the investment in equity securities has to go away. We no longer own it. We're going to take it off again. It was being carried at its cost of 55.1. So what's happening here? Well, our assets are going up and they're going down. We've already recorded all the income and losses that we need to on the income statement because of the adjustments we've done. So here we're simply removing. So our assets are going to go both up and down. So it's going to be a plus and minus to our assets of a 55.1. Okay, because we got the fair value and the cash. That's our debits. And then the investment there is our credit. Now, statement of cash flows, this is an inflow of 31.7, and this would be from investing activities. So we would go in and hit an inflow from investing. All right. Now, really quickly, you don't have to do this, but what happens if we post reverse? So some companies may sort of do this little instance here. And we probably have to add a few rows. I'm doing this on the fly, so y'all just bear with me. Remember, no matter how you look at it, you have to report a total loss of 23.4. Part of that loss has to be reported in the prior year and part this year. So notice how we made this adjustment for 16.7. What you could do is at the beginning of the new year, on the first day, we could reverse that out. And this is how we did it at my old job. Hold on, what year were we in? We were in 24, we're in 25 now. So on January 1st of 25, we could go in and just simply reverse the fair value adjustment and the loss. And we would do that at that full 16.7. So you're like, whoa, wait a minute, what's going on here? Because we just reduced our assets, or increased our assets back up, excuse me. And then you're reducing your loss, so you're actually increasing equity. And you're like, wait a minute, you're showing a gain. You are, but what this will allow us to do is when we actually sell or readjust, we can just simply always take the difference between that initial 55.1. So then when we actually sell this asset, so let me get rid of this. Oh, 16.7 there, sorry. There we go. Now, when we actually sell this asset on the 20th, we don't have to worry about the initial. So we're going to record the cash at 31.7. And this we'll just record a full loss on investment. Now here you could you're going to do the realized account. And I think I built this in. Let's hope I did. I did not, so hold on. Let's see what we've got. Cancel. We should have a loss account. There we go, just loss on investments, not the realized NI, just NI. Now here you're going to take the full amount of the loss, which was 23.4. You're like, whoa, but we didn't lose 23 this year. That's okay, because what happens is the reversal of this 16 and then the recording of this loss creates that 6.7 that we reported. So I'll show you that here in just a minute. And then we would get rid of the investment account. Investment in equity securities, I believe. So there we go. And that would be the 55.1. So notice the income impact is exactly the same here. So when we go over here, our assets are going to go up by 31 but down by 55. So we're losing that 23. Our equity here goes down by the 23. So we have a loss of 23, which creates, actually this would be a reversal. I did that backwards, 16.7. See what happens when you go on the fly. Notice we took our losses. This is a loss and we're crediting it. So that would actually cause our expenses, losses to go down, which would cause our income to go up. Here we're debiting the loss. Here we're debiting the loss for 23. That's going to cause our equity go down, so our losses to go up, which makes our income go down. So by doing that reversal and posting at the full amount every time, you still create that loss of 6.7 in the current year, just like we needed to. So some companies will post reverse adjusting entries for equities. So when you do the reversal plus you actually do the updated based on the true historic cost, it always nets out for that period of time. And that way you don't have to necessarily track, well, what's in my fair value from last year? It's zero because you've reversed it out. All you have to do is repost. So when I was in industry, this is what we did every single day to get that daily fluctuation of profits and losses. So we could report P&L for the day. Did you make money this day? And it was simply the difference between what we had reversed out and what we rebooked that day. So it was really cool to be able to do that. So some companies will. Two different methods, you end up with the exact same results. It's just slightly different ways to get there. Okay? All right. Now, cash flows would be the same. You'd still have the inflow of 31 from investing, so that doesn't really change at all. So a couple of different ways you could do it. Again, I just wanted to show you that. What if they use the post reverse? That is not part of this problem. It's just an add-on because, you know, I get bored sometimes and just want to throw stuff at you for some odd reason in that. So same end result, different ways to get there. Okay? You're like, how does that look? Or how does that end? And that's sort of what it would look like. All right. Any questions, let me know, but y'all have a great day.